Hello, hi everyone. This is Dr. Yugender. I'm going to explain you financial statement analysis. An introduction part means I'll explain in this lecture about financial statements and just a basic part of the financial statement analysis. This lecture will helpful to CFA students. Don't worry, I'll also upload the videos which are related to the CPA also. Thank you. Yes, so if you have any doubt after watching this lecture, please contact me at dr.yugendhar@gmail.com, drugender@gmail.com. If you like this lecture, please go to www.facebook.com/online-CFA-CPA/info and please like this page. Financial analysis is very simple process of examination or examining the company's financial performance and financial stability in an economy. The basic intention of financial analysis is to get some decisions. Means after analysis is done, the analyzed data will be helpful to the parties. Who are the interested parties? For example, when we come to the decisions are related to investors, means the decisions whether to invest in the company debt or equity and at what price, they have to know first, then only they'll invest. So this information, this data is available only on the basis of financial statement. And basically, an investor in debt securities is concerned about the company's ability to pay interest and to repay the principal, because he is only investing in debt securities. He want a minimum interest or a agreed interest from the company, and at the end of the means at the time of maturity, the company has to pay his principal amount back because he is only investor. And second thing is, an investor in equity securities is concerned about the company ability to pay what? Dividends, and the likelihood that its share price will go increase. He is expecting that if the share price will go increase, then only he will invest. Otherwise he will not invest, because that will not give a good return to him. Okay, so how can he know that? He is basically the debt investor and equity investors are interested on company's financial statement analysis, because debt investor interested in regular interest and repayment of principal at maturity, and equity investor very much interested to know whether the company pays a good regular dividend and share price will go up in the future. So all these required information to them is available only after analysis of financial statements analysis. Hence, overall a central focus of financial analysis is evaluating the company's ability to earn on its capital that is at least equal to the cost of capital to grow its operations and generate enough cash to meet obligations, all its obligations. The company at least earn to maintain all its obligations. So because the company has to pay dividend, the company has to pay interest, the company has to pay salaries, all this comes to, for example, 10 million. So in analysis we have to find out whether the company able to make $10 per annum, $10 million per annum or not. This is very much important in the part of analysis. Basically analysis is only depending on financial statements. We don't have any other information regarding the company. Only the company presents a financial statements, financial reports. On the basis of financial report, we have to do analysis. This analysis is called a fundamental financial analysis. This is starts with the information found in only company's financial reports, financial statements. Basically, this company's financial statements are income statement, balance sheet, cash flow statement. In addition to that, we have some other reports also. So a complete set of financial statements includes a statement of financial position. A statement of financial position. What is the statement of financial position? It is nothing but the balance sheet. It's a balance sheet. It consisting of assets and liabilities of the company. Next, a set of comprehensive income statement. A set of comprehensive income statement, or we can call it as a income statement. A statement of change in equity and a statement of cash flow. Basically, all these financial statements are very much important and all plays an important role in the process of analysis. Okay, so balance sheet, it expresses the financial position, financial ability. It shows the assets and liabilities of the company. A comprehensive income statement or income statement. Income state shows the operations, revenue generation of the company. It shows the revenue generation capability of the company. A statement of change in equity. So when the equity, how the equity changes, it must be important to the investors to invest in the company, to buy their share. Okay. Next, cash flow statement. And what are the sources to the company, and what are the expenses to the, what are the sources to the company, means resources from where the company is getting a bank loan, that is a source to the company. Okay. The company is issuing shares and getting money, that is a source to the company. And uses, where the where the sources are used in the company, and what is the advantage if you use the sources for purchase of machinery, plant, equipment, all these things. What is the need? Is there any need? Are they generating income or not? This process is very much important to invest in the company. So basically, financial statement analysis is depending on these reports and financial statements only. That is the reason we are calling it as a financial statement analysis. Not directly we are calling analysis or financial analysis. In addition, not only these statements, in addition, we have some footnotes also, and these are the integral part of financial statements, no doubt about it. Footnotes are integral part of the financial statements. In footnotes, the directors, management express something, express their required information which is related to the financial statement. Some of the additional information also provided, which are chairman's letter, and a report from the management discussion analysis. It is nothing but MDA, we are calling it as. And auditor's reports, it is very important. Auditor reports provides as assurance. Okay, if auditor report is clean report, then it is an assurance that we are doing analysis on accurate financial statements. Okay, if the auditor statement is auditor report is not providing any assurance, means the analysis is waste, because whatever you are taking, the basis for analysis is not a fact, so our analysis will be failed. This is very important. Next, a governance report describing the structure of board of director and corporate responsibility report. This is very much important nowadays. The corporate responsibility is related to the internal control also, internal control system of the company. So all these additional information also included. these are creates some evidences, some good confidence on the company. The financial statements whatever presented by the company are showing some sort of true and fair view on the basis of these things. Now I'll explain you one by one financial statements in detail. The first and important aspect is balance sheet. Balance sheet is the statement of financial condition. It is also called as a statement of financial position. It presents company's present financial position by disclosing the resources. Resources are nothing but the assets and its obligations to lenders. Means the company has to pay some loans also. The company has to pay some bank loans or other lenders, and it also represents other creditors at a specific point of time. So this is basically expressing the showing the assets and liabilities of the company, and it is also representing owner's equity or a residual interest in the net assets of an entity. Okay, means after deducting assets minus liabilities, we will get the owner's equity. I will explain you. Okay. And owner's equity represents the excess of assets over liabilities at a specific point of time. This amount is attributed to the company's owners, means real owners or equity shareholders. Please remember, it is owner's claim after deducting all the liabilities from its assets. See here, the relationship among the three parts of the balance sheet, assets, liabilities and owner's equity, will be expressed in this equation. Assets is equal to liabilities plus owner's equity. Okay, when you want owner's equity is equal to assets minus liabilities. So owner's equity is equals assets minus liabilities. Okay, assets minus liabilities. In definition, I already told you, it is the excess of assets over liabilities is nothing but the owner's interest, that is owner's equity. So equity shareholders generally. This equation is also called as a balance sheet equation and accounting equation also. And the next thing in the financial statements is income statement. The income statement presents information on the financial results of the company's business activities over a period of time. It communicates how much revenue and other income the company generated during a period and the expenses it incurred expenses to generate the revenue and other income. Simply, it communicates how much revenue and other income the company generated, and to generate that income, how much expenses incurred. This is where here amounts charged for the delivery of goods and services in the ordinary course of business. Expenses reflects outflows, depletions of assets and incurrences of liabilities that decreases equity. Expenses nothing but the cost of sales, administrative expenses, income tax expenses, maybe some other losses also. Other incomes such as gains may or may not rise in the ordinary course of business. So here the most important aspect is to find out, this statement is prepared to find out the net profit. If the company is producing net profit, means the company financial performance, means working activity performance, financial activity performance is somewhat good. It is generating the huge revenues, huge profits, huge net profits, then we can say the company financial performance is healthy and sound. So to know that, we are finding net income on the base of this financial statement. We are getting net income. Net income is very simple. Net income is equal to revenues plus other income minus expenses. Net profit is the bottom line of the income statement. We know it is also referred as a net earnings. It may be net profit or net loss sometimes. If the revenues are more than the expenses, we can say it is the net profit. If the expenses are more than the revenues, it is the deficit or net loss. We also know that here other comprehensive income. So other comprehensive income includes all items that impact owner's equity but are not the result of transactions with share owners. See, while doing the next lectures, I will explain you the differences between income statement and comprehensive statement. At that time, I will also explain according to the IFRS and GAAP the difference and preparation aspects. Next foremost important is cash flow statement. Cash flow statement discloses the sources and uses of cash, which helps creditors, investors and other statement users evaluate the company's ability, liquidity, solvency and financial flexibility. Ability means financial ability. Cash flow statement classifies all cash flows of the company into three categories. One is operating, second one is investing, and third one is financing. So operating cash flows, investing cash flows and financing cash flows. Operating cash flows involves the cash effects of transactions that enter into the determination of net income and hence comprise the day-to-day activities of the company. So it is the cash flow, the cash generated by the company's normal business operations. It indicates whether a company is able to generate sufficient positive cash flow to maintain its operations or not, whether it may be requiring additional funds, additional financing. So this is very much important, because a company is not able to run its normal operations. Okay, how can an investor believe? How the bank provides the loan for us? So if we are in a good position to operate all these things, then the company then the bank will provide as a loan to purchase a plant or equipment, something. So the operating cash flow is very much important, because the cash is the blood in the organization, blood in the corporate. If the cash flow is not good, then it is impossible to sustain in the economic environment. The second aspect is investing activities. Investing activities are those cash flows from activities associated with the acquisition and disposal of long-term assets such as PPE, okay, property, plant and equipment. So this is very much important. All the operations are done as per the plant equipment only. If the plant equipment is not good, then it is not possible to produce the goods and services. It is not possible to sell in the market. So the operations will stop. So investing activity is also very much important. Here only the sources and users will be identified by the users or evaluators, analysts. The last and final is cash flow from financing activities, or those cash flows from activities related to obtaining or repaying capital to be used in the business. Financing cash flows are resulting from issuance or retirement of debt and securities and dividend payment. So if the company is regularly issuing the debts, means the company is not able to generate its regular operating revenue, and the investment is going up or investment is going down. Okay, so this will indicates us the company's flexibility, solvency and liquidity. Okay, so first we have to analyze all these things to get proper information. Here is the other important information credentials, such as footnotes, supplementary schedules, management decision analysis. Sorry, before that we have one more thing is owner's equity statement of change in owner's equity. Okay, statement of changes in owner's equity is the report the changes in equity investors investment in the firm over a period of time. The statement of changes in equity, variously called the statement of changes in owner's equity or statement of changes in shareholders equity, primarily it serves to report changes in the owner's investment in the business over a period of time. The basic components of owner's equity are paid in capital, means paid up capital, and retained earnings, and minority interest and other resources that represents other comprehensive income items are included in equity. Once again I am telling you, statement of changing owner's equity includes paid in capital, retained earnings, minority interest, reserves that represents other comprehensive income items are included in equity. Okay, here the important point is other important information credentials, such as footnotes, supplementary schedules, management decision and analysis. Under footnotes, the important information about accounting information, means accounting methods, such as whether the company is now the company is following diminishing balance method or straight line methods for the plant, equipment, machinery. Okay, and what are the estimations, cost estimations, means for production of goods and services. If we go for lease, this is the regular lease payment. If we go for the purchase of the equipment, this is the cost and capital budgeting. Everything will be explained under footnotes. So important accounting information, accounting methods, estimates and assumptions are disclosed in the footnotes. Okay, because if we have any doubts regarding the financial statements, will be cleared under footnotes. These are the simple notes expressing something written about the financial statements. Next, supplementary schedules discloses and information about the segment results, committees and contingencies, legal proceedings, if any legal proceedings are there, acquisitions or disinvestments. For example, segments, we have two or three branches in London, UK. Okay, we want to acquire some more company in India. Okay, we are going to acquire something, or we are going to disinvest in UK. So all these information will be explained under supplementary schedules. Okay, issue of stock options, employee benefit plans, number of employees, what are the benefits to employees, everything will be mentioned under supplementary schedules which are related to these items. Management decision and analysis. In the name itself, it is a decision. Management decision means it's a final ultimate decision. Management and board of director decisions will be taken, and to take those decisions, what are the analysis behind that will be explained under MDA, management decision analysis. Important information about the trends and futures. What is the trend and what we are going to do in the next coming future? To do that, what are our capital needs and capital requirements? If we enter into the project, what is the liquidity? And many essential significant information which are related to the accounting methods and acquiring management judgment will be explained under MDA. Okay, we have all these financial statements, cash flow statement we have, equity statement, equity chain statement we have, and the directors reports we have, MDA is there, many things are there, but whether they prepared correct or not, if we start analysis on these items, based on these items, we will get results. But see, whatever we taken as a basis, financial statements, those are correct or not, we don't know. So here the important is we have to take audited financial statements only for financial analysis. If not audited, please don't go for the financial statement analysis. After that, if audited, the balance figures will be changes. So please, so the basic intention of objective of audits of financial statement is to provide an opinion on the financial statements fairness and reliability, whether the prepared financial statements are prepared in accordance with the GAAP and in accordance with the international financial reporting standards or in accordance with the universally accepted accounting principles or not will be identified by the auditor. Okay, the auditor identifies, examines financial statements and examines books of accounts, and finally he will give his opinion, his review, and he verifies that whether the companies followed appropriate accounting principles or not, the statements contain any material error, or the company is doing any fraud or not, the management prepared management concentrated well on company or not, what is the internal control system of the company, whether the internal control system is every time verified by the management or not. Okay, everything will be checked clearly, and finally gives his opinion. If the opinion is good, then go ahead for the analysis. If the opinion is not good, then stop your analysis process. Auditor gives us almost all 4 types of the opinions. The first and important opinion is unqualified clean opinion. Whether the statements are free, when the statements are which is issued by the auditor, when the statements are free from material errors and omissions. An unqualified audit opinion states that the financial statements give a true and fair view, and the financial statements are fairly presented as per the international and US applicable accounting standards. Okay, means no doubt about the financial statements, these are very clean. Then go ahead for the financial statement analysis. Second one is before second one, I want to explain something about the first one. This is often referred as a clean opinion. So the second one is a qualified opinion. It tells us exceptions to the accounting principles, means those financial statements are having some exceptions, means those financial statements are not prepared according to some of accounting principles. A qualified opinion is one in which there are some exceptions. Okay, next, an adverse opinion. If the statements are not presented fairly in the auditor's opinion, this is an adverse opinion. Adverse audit opinion is issued when the auditor determines that financial statements materially depart from accounting standards and are not fairly presented. And the final one is a disclaimer of opinion. Disclaimer, in the name itself they are explaining disclaimer. He is not giving any opinion, means the auditor is unable to express his opinion because he is not able to read the financial statement sometimes. An adverse audit opinion, a disclaimer of opinion, which occurs when for some reasons the auditor unable to issue an opinion. Finally, the management is responsible for maintaining an effective internal control system to ensure the accuracy of financial statements. So this is the main intention of the management, to control all accounting to control all internal controls in hand and make sure that to improve efficiency of the organization, basic especially in finance department. Hope you happy in this lecture. Please donate something to this email ID through the PayPal if possible, and try to improve try to increase more lectures from me. I will try to upload all the videos which are related to CPA, CFA and MBA. Please donate something to PayPal, at least $2 donation for next videos. Thank you. Thanking you. And please don't forget to contact me for any other online help. Please note that www.facebook.online/online CFA CPA /info, and please contact me at dr.yugendhar@gmail.com. Always happy to help you. I'll do all university exams, quiz exams and everything. Please, once you go through this website, and you will find everything which related to the online education. Thanking you once again. Happy to help you. Bye.